Well, hello, welcome back in. It's time to talk about your money, or right now the lack thereof, because of this inflation. But could things take a turn for the worse in the form of a recession? Joining us with analysis is financial expert Marshall Clay with the Welch Group. Good to see you this morning.
Hey, good to see you.
First, I'm not sure everyone understands what happens when we're in a recession, but explain the pitfalls that could befall anybody if we hit a recession.
Well, so the historical technical definition of a recession is 2 quarters of negative gross domestic product, and gross domestic product's a function of consumption, government spending, net imports and exports, and so that's kind of a nerdy way of looking at it. But the way it can affect various people, it can affect people in different ways. So when we're talking about how a potential recession could affect investors, I think we've already seen a lot of that, right? We've seen the stock market pull back approximately 20%. So if you're a pre-retiree or retiree, obviously you want to take a little bit more of a defensive position.
Okay.
Maybe look to raise a little bit more cash, probably at least 1 to 3 years, ideally up to 10 years of your estimated annual cash flow, to guard against recessionary environments. If you're a longer term investor, if you don't have reliance on the portfolio in the short to near term, I think in this environment you can be a little bit more aggressive, right? We've come off about 20% from the highs, and I tell younger investors, don't let the next 3 to 6 months influence your 3 to 5 year outlook. And I'm highly confident that over the next 3 to 5 years, investors will be fine.
Now, a lot of times when you hit a recession, companies aren't making money, so they have to let people go. But what if you are a worker? What do you need to do to protect yourself against risk there?
Yeah, so I think a lot of people that have been in the workforce for the last 10 or 15 years, they experienced that really bad recession in 2008, 2009. But I think it's important for workers to look at the response function of their various employers, right? So they know the industry that they're working in. I think right now you see some vulnerabilities in all these upstart companies, primarily technology companies, crypto. A lot of jobs are being lost there. But the fear is that could start infecting more of the traditional employer environment. So,
okay.
If you're a worker, you want to look at the response function of your particular company during the last recession. If you can't figure that out, maybe ask some people. But really, that's going to lead you to what we're going to talk about next, about how households should be looking at spending.
All right. So if you have a household, how should you look at spending right now and just protecting yourself?
Yeah, I mean, I would just be looking to pay down all of that high interest credit card debt if you have any out there. Obviously, look to raise that emergency cash reserve a little bit, probably 3 to 6 months of emergency cash there, and really just evaluate your budget in general. Only make necessary purchases, right? Because we're starting to see some canaries in the coal mine, like I said, as far as these tech companies reducing jobs. Hopefully the Federal Reserve can navigate what they're calling that soft landing.
Right.
Historically, they have not been able to do that, or have not done a good job doing that. So you want to prepare for the worst and hope for the best.
So maybe don't buy that new truck. Maybe hold off on that very, very expensive vacation if you're on one of those at risk.
That's right.
All right.
That's right.
Marshall Clay with the Welch Group. We do appreciate it.
Oh, you're welcome. Thank you.